Investor fear grows. This is Tom Aspray with the Viper Report Market Wrap video. Last weekend we talked about the very low bullish sentiment in terms of the investors. This week we heard more concerns from the pros. Not too surprising with this market action. This gives you the weekly rundown, led on the downside by the Russell, down 4%, NASDAQ 100 3.2, Q's about the same, obviously. S&P down 3.1. The industrials down 2.37. Transports down 2.35. NYSE composite about the same. Utility average was down 1.3. Gold was the big winner. In terms of this week's survey, there wasn't a lot of change. One tick lower in the bullish percent, 19.4 versus 19.3. Bullish or bearish came down a little bit from 60 to 57.1, still quite high. We pointed out last week that both the AAI bullish got down to 19.3. You can see that was a low we saw in 22, and then back at the end of the bear market in 2009. More impressive is when you look at the difference between the bulls minus the bear. You can see we had a low here of about minus 50, I think, at the 2009 low, and we're at minus 37. So minus 30 is where this line is. That's normally, you follow some of these up here, there, that often coincides with a major low. This was a pullback in a strong uptrend in 2013. The bottom line is that last week, the uncertainty over the tariff, the on-again, off-again tariff status, as we've mentioned many times in the past, is really creates lots of uncertainty, not only because for investors, but also for those trying to plan what they're going to do. For example, one shoe manufacturer I saw an interview with had budgeted when he made his shoe order last fall for like $50,000 in tariffs, and now they're going to be $180,000. You can imagine if you were in any type of business you were in, if you had to try to deal that. Sure, at a one-time basis, your store floods, you might be able to do it, but not on ongoing. So look at the SPY Trust. You can see we dropped, down to a low of 565.63. About 3 weeks ago, we were looking, and what I teach my students is so if you see signs of a market correction, you want to look at, well, how low can it go? And then once you determine that percentage, then you can decide whether, okay, I'm going to, sell a bunch of stuff or, just write it out and, whichever. I mean, in my retirement things, I don't change unless we're in a bear market. So pretty much we've been long, same thing, throughout the bull market. So, and I don't really see signs yet of a bear market, but you keep an open mind. So back 3 weeks ago, we looked at it was right around 677. A 2.3% would be take you to 586 and change, 575 or 566, which was quite close to this low. And, a decline of 7.7% on a closing basis. So volume high on this decline. So getting up to where it was at the end of the year. AD line, the S&P AD line, has formed a negative divergence. That's still a problem. Since the S&P made a new high, and as evidenced by this chart, the AD line did not. It's still above its moving average. It'd be much more negative if we drop below the support. The NYSE stocks only also shows lower highs, but the NYSE did not make a new high along with the S&P. That's why there's no divergence. The NYSE all is just closed fractionally above. So stocks only negative. You can see the numbers here. All AD, is like literally 8 issues above its moving average. So it requires a good week of advanced decline numbers in the coming week. One thing I look at on a regular basis is this what they call a percentage performance chart. So this shows you what happens. So you can see the Invesco QQQ dark blue, S&P red, the unweighted QQQ is in lime green, the unweighted S&P is in pink, and then the NYSE composite is in blue. So you can see this last part of the rally in February, all of a sudden the unweighted QQQ was leading by a pretty good margin both the Qs, the S&P, and the equal weighted S&P. You can see, and the NYSE composite was doing a good job, and that I think is still a positive sign for the intermediate term, because it says the common stock is starting to participate more. Obviously, in the last couple of years, it's been the Qs and SPY. So if we come out of that in the next rally phase, that'll be important. You can see on the downside, we have the Qs, and you can see the equal weighted here. If you were in that, you had about a 5% differential currently, and the unweighted S&P is about even, whereas the unweighted or the weighted is about down 3.5%. This is also a handy chart to use if you have stock charts to compare, different, stocks or ETFs, in the same thing. So like if we look at this, you can say, well, okay, let's look at XLF, the financial ETF, Goldman Sachs, British Bank of America, Wells Fargo, and you can see kind of, you look like what's been happening in the last day. This is a longer term chart. You can see, that Goldman Sachs, has come from 10% up to 8% down. Bank of America is, it lagged here. So when you see sort of stuff like this, and you're in one of these stocks, you can say, well, gee, Goldman Sachs is acting the best, which is if you're looking to buy, but if you're, worried about a position, the lower highs here in Bank of America was not a great sign. You can see the overall financials, are holding up much better, as you would expect. If you're trading or investing, if you want something that doesn't move quite as dramatically, pick the sector ETF rather than the individual stocks. Still some interesting things in the daily AD lines. A lot of divergences. We have here the Spider Trust. So, made the new low there, and then, managed to, close the day, up higher. That's a good sign. I mean, it's a minor reversal. It's not like a key reversal where, which has marked some of the corrections recently. So what's next? I mean, still the odds favor, a rebound back. So this dark blue is the 100-day moving average. That's at, 592. In pink, we have the 50-day and the 20-day here at 591. So you're right around in here. That's where, if this rally is going to set the stage for a further decline, then that's where it should fail. Conversely, if we do see if the worst of the selling was over last week, which is a possibility, we'll be looking at things like the S&P AD line. You can see, we've been plunging here, but this is a sign that, a lot of the decline in SPY was just tied to a few stocks, and it closed positive. You look at the NYSE All, it looks much more negative. This does not suggest a bottom. For this to bottom, you need to get above this moving average, and then it's downtrend. NYSE All, so it has bonds in it and bond funds. It's negative, worse than the S&P, but not as bad, as the stocks only. And the weekly chart of the DIA, which tracks the Dow Jones Industrials, still looks pretty strong. The AD line is acting stronger than prices. And you can see the yearly pivot here. That's at 413.41. Recently wrote something in Forbes. I'll show you the link later about how interesting the yearly pivots can be. We're getting a lot of ETFs that have either closed the week below them or close to it. So that if they close decisively below their yearly pivots for 2 consecutive weeks, then that's to me is a change in trend. You can see this is a good example of how well they can work. In 23, we got chopped along a little bit. They opened up above the 20 of the yearly pivot, dropped back below it, and then held it in 23, and then pretty much have not had a lower weekly close below it, until yearly pivots. These levels here are based on all the price activities in 2024. The weekly chart of the QQQ still looks positive. You can see we got down below the pivot during the week. The pivot here is 483.29. The low was 480.53, but we closed it at 491.79. So still a positive trend here. It's done a really good job on the Qs going back, over a long period of time. AD line had made a new high, so it's leading prices, so that's strong. The relative performance, this measures how it's performing against the Qs. It took a hit this week, so it dropped below its moving average. Whether that's going to last is up to be seen. So let's look at the growth value analysis. The ratio plunged this week, as growth lagged value. But now we're right back into support here. You can see this drop here looks very similar to the drop we had, from the, I guess it was the May-June high, down to the, August low. So MACDs are negative, so we'll see what kind of a rally. I'm not willing to say that rally in growth is over on a longer term basis, but usually these things take time. You can see we had this decline from end of 21. Of course, no one knew at that point, wasn't clear until we got into early 22 that all the growth stocks were in their own little mini bear market, which acted very well because of the ratio until we turned back around in early 23. I've been talking about the equal weighted Qs, the QQEW, for a trade. Unfortunately, I thought this support here around 128 would hold, and it didn't, so we were stopped out. Interesting, though, when you see stuff like this. So this low back in January was 123.51, and last week was 123.54. So if this really were a bottom, that'll be quite interesting. Too early to tell that. The pivot here is at 129. I learned something interesting last week, and so it's always new things you can find out. One of my other platforms allows you to determine what the weekly pivots are in the coming week after Friday's close. Shouldn't be surprising because your data is not going to change. But in chalk charts, if you look at this is as of the close, on Friday afternoon. We just have the pivots here, are not shifting forward. But I found that if you add extra bars in here, like 5 extra bars, and hit update, then you will get next week's pivot is at 495. So that's the first resistance level. We're already close to that. So rally could stall there. For a better rally, be looking back towards 509.71, and then of course you can use their fib calculator to look at what it looks that way, and you get something more like 50% is in the 510 area, 510.88. So failing rally, if you're bearish and you think about buying puts, that's where you'd look for the rally to stall. If we need to really get a close back above the 61.8 to signal that the worst is over. A new chart for this week. I'm taking up lots of time here, but this is the NASDAQ composite. So during corrections, it usually gets creamed worse. You can see, it peaked in the late 21, and dropped from, I guess, 16,000 down to, 10,500 or so. Huge hit. So it's just closed 18,196. So that's, just above the yearly pivot at 18,101. So we'll be looking for what kind of rally we're going to see this week. You can see there's longer term support here, the uptrend, and the S1 here right around that 1600 level. New high, new low, is still negative. The spike we had in new lows in the NASDAQ. Didn't see as many new lows, even though the market was lower. That's an encouraging sign, but too early to say that that's really a change in trend. You can see we'd probably see a move above 250 new highs to indicate there was some serious buying. If we look at the, this is the NYSE daily with its nice uptrend on the AD line, so that's a good sign. And the NYSE composite, you can see it's also got a spike here in the new lows, but it's dropped off. It was close to 300, just 71 on Friday. So we'd like to break this downtrend here, get it back above 160 or so. This peak right here to suggest that's finally turned. This chart of the S&P 500 shows you've hit this black line, which is 200-day moving average, spiked pretty much well below that, before closing, higher on the day. So, the 20-day moving average is declining pretty sharply, so, best case scenario is a rally back to that, and then we're either going to see a pullback that holds. We should be able to tell that more from the AD numbers, and then that'll give the 20-day chance to turn higher. Otherwise, if we just see a quick bounce up and then we see some heavy selling, that's going to turn the focus back on last week's lows. So the S&P percentage was 38% were positive. We had some buying. Each one of those mornings, you guys who watch the markets, we've had some pretty nice, up 39, up 40 points in the futures, and they don't even last, till the open sometimes. So that's usually, that trend has not changed. S&P 1500, a declining trend, and same for the NASDAQ 100. It is significant that, these red bars, show a fair amount of selling pressure, which is a sign of the oversold status. The analysis of the VIX and VXN are still negative, been in an uptrend. We talked about the breakout here, a couple of weeks ago. So, they're in a gradual uptrend. So, if we get a rally, it'll be interesting to see how well they hold up. So do they hold around the 20 level here, or do they, get down under 18 or so? That'd be something to take a look at. Consistent with the movement in the weekly QQQAD line, you can see the daily is right back down to testing support. So that'll be watching to see how those numbers materialize if we get a further rally. That is likely next week. It's just a matter of whether it takes over by, Monday's opening, or when, or in the middle of the week. Back to the watch list, there are a number of negative signals. AWD, that's your iShares value. Transportation is junk bonds, crude oil, energy ETF, financial ETF, utility ETF, XLF, also the financial, XLU, and DIA. The only thing we're positive here was VanEck, Rare Earth, and PIC, which is another mining stock. When I talk about oversold, you can look at in yellow over here the number of stocks. When they're yellow like this, it indicates that they're below their Stark bands. So for example, they moved down during the week below them. So That's you don't see too much. The only ones that are overbought are like Europe, and the FTSE. This is Europe also, and the currency, ETF. But most of them are pretty. Here's we have VGT and SPY. They're all showing these really readings. So, when you get down to the weekly Stark bands, that's often a sign that you're looking for at least a rally. If you're really negative, then you would look for a 2-week rally that would fail. If you're more positive, like based on the QQQAD line, then you just think this is a strong correction in an ongoing uptrend. Quick look at the themes report here. You can see that the NQ largest holdings, only 12.5% have a 3-day positive DTS, same as the weekly and the quarterly. They're all 12, so that's pretty oversold. AVGO is one of the few that's just trying to come out. So for a turnaround in here, we'll be looking for some green in the daily, and then look at the individual technicals. The Dow, as I mentioned before, is acting better. And you can see it's got a lot more green here. Amgen, McDonald's, Caterpillar, and United Healthcare, which got smacked a couple weeks ago, is trying to come back. And the volume there on a weekly basis, was above average. That's what these numbers tell you. Green is above average, red is below average. Or red is above average with it closing lower. So that's an important consideration. If you want to find what I'm writing about on Forbes, they eventually end up in the Viper report. But you also always search Forbes : Tom Aspray. You get the entire list, going back to 2011 or so. So if you're looking at my articles, the last one was Staying with the Market's Trend, talks about the use of yearly pivots. Okay, they're based, as we talked about a little earlier, on the prior year's price activity. And there's just levels, one set of levels to watch, for the entire year. So basic interpretation is if you have 2 weeks above it's a positive signal, 2 weeks below it. You can see this chart of SPY. You can see during the COVID collapse, turned negative right here, got down to so this is the pivot, S1, S2, made it to the S2, and then, by June we were back above the yearly pivot, turned positive at that point C, and then by the end of the year we made it up to the R2. Can be pretty impressive. Chart of XLC in purple here shows you the yearly pivots, and it still looks strong. So, and this table gives you the yearly pivot for all the key sector ETFs. Just watch these numbers. In a positive trend, a pullback to the yearly pivot that holds gives you a well-defined, opportunity for it. We're working on another article on the yearly pivots, and that last one will be up on the Viper report before Monday. So more articles here. If you're interested in real-time advice, the Viper ETF or the Hot Stocks report, and we're still doing some one-on-one training. Could be the last year I'll be doing that, but if you're interested, it's I think a unique opportunity, even though I'm somewhat biased. Hope you have a great week, and don't get too freaked out by the market action. We've survived worse and will likely survive this. It's just a matter of having the market timing on your side. Thanks for tuning in.